Drastic step has been taken in China to try to halt a massive plunge this week in global stock prices, which is starting to roil global financial markets. China's securities regulator banning shareholders with stakes of more than 5% from selling shares for the next 6 months. It says on its website it will deal severely with any shareholders who violate the new rule amid warnings of panic sentiment gripping investors. Well, our business editor Stephen Carroll's with me here on set. First of all, Stephen, let's have a look at the market, shall we?
Yes, well, of course, after those huge falls that we saw in trading on Wednesday, the Chinese markets have bounced back pretty significantly today. The rollercoaster ride is continuing really across Asia. I mean, here's the picture now. So Shanghai opened down 3.8%. Now it's up 5.7%. The Hang Seng Index as well has done something quite similar throughout the trading day as well. This is in line with what we've been seeing for days and weeks now on the Chinese markets. You have enormous bounces in a single day of up and down. This week the trend has been mostly down. In the past 3 months, or in the past 3 weeks rather, we know that Chinese shares have lost more than a third of their value. There's been massive sell-offs. One trader describing the Hang Seng Index in Hong Kong yesterday as being like an ATM. People were just taking their money out to try to raise cash, because there are, of course, people who can make money out of this as well, because if you're short-selling stocks, you can take things out, wait for the price to come down and earn money when the prices are lower. It's been a pretty steady tumble, I suppose, on the markets, though, since then. Many companies simply just taking the quite dramatic step of just taking their shares off the market altogether. Yesterday, we were looking at 1,300 companies. There's another 200 today, according to Bloomberg, have suspended trading in their shares. That means more than half of the companies listed on the major indices in China have suspended their shares from trading. You've a market that's half in free fall and half entirely frozen.
So what's the government trying to do about it? What have they done?
Well, the government and the various regulators have been taking steps now for several days to try and clamp down. You mentioned the ban on major shareholders, those that hold more than 5% of a company, from selling their shares. That applies to company directors and to senior management in companies too. Earlier in the week, they'd asked state-owned companies to buy back their own shares in an event to try and bring back some sort of stability to the markets as well. Interest rates have been cut as well, trying to encourage people to borrow, to buy more shares. The government also offering financial support to more than 100 brokerages who've pledged to buy shares and keep them for a year, just to try and give some sense of stability to the markets. That's so far, though, only really managed to help the big state-owned companies on the markets. Smaller companies still being very hard hit on the share markets.
And give us a bit of a beginner's guide. I mean, just explain to us why on earth this is happening in the first place.
There's a whole range of reasons, but this is part of a whole drive that the Chinese government has been doing now for months to try and encourage small private investors to put their money in the stock market. You've had the state-controlled media pushing people to invest in stocks. It's been a frenzy in China for people to just put their money into share markets. Some people have likened it to the dot-com bubble. You have, taxi drivers investing in technology companies trying to make their money. And as a result of this, you've ended up with a very unusual situation in the Chinese markets where 85% of investors are small, what are called retail investors, people holding small amounts of shares, buying and trading them themselves using brokers. In other more developed markets, you have fund managers, professionals in there managing the money who move shares around on a daily basis, but are used to that sort of modulation of markets, the up and down. That's changing things. Small investors are more prone to volatility because they see their share falling and think, well, I better sell this now before it goes down any further. And that's provoked some of these massive swings we've seen from day to day. Over a year, though, it's worth pointing out that we've had 3 weeks of dramatic falls. Over the previous year, shares in China were up by 150%. So the stock market boom that was created by this push for people to invest in the stock markets hasn't been entirely wiped out. I mean, the Hang Seng Index, even this year, is up on the year. Of course, Hong Kong's slightly different because there's a lot more international lending involved. What provoked this latest rout was a clampdown on what's called margin lending. That's essentially using borrowed money to buy shares. They clamped down on this because there were a lot of online brokerages springing up to kind of get people to, borrow more money to buy shares. Once that's been clamped down, those people have to sell those shares essentially, which is why you're seeing these big falls. That's where we've seen this latest rout come from. There's no sign of it stopping just yet. We're still seeing these roller coaster rides taking, and these measures, some people are saying, won't help.
If you didn't understand it before, hopefully you
do now.
Exactly. Stephen Carroll summing up for us now from our business desk. Thanks.